Joining me now in a Fox Business exclusive, Goldman Sachs Asset Management Global Co-Head of Private Credit, Vivek Bantwal. Vivek, suddenly, over the past couple of weeks, let's call it a few months, there were a lot of investors saying, I need my money out. They got nervous because there were two high-profile problems. There were, criminal accusations for two companies that had been lent a lot of money from private credit companies. Where do you think this all really kind of stands right now? Is it just very, very focused on a small group of companies or way more?
Thanks for having me. So look, I'd say a couple things. First of all, I think it's important to separate the anecdotes from the data and to separate what's in the data right now, so what's actually happening, and then we can kind of talk about or guess what might happen in the future. When you think about those cases that have gotten headlines, I'd point out a couple of things. One is, as you referred to, some of those instances involved allegations of fraud.
Okay, let's just say, for people who don't know, a company called Tricolor and another company called First Brands. Two of them with separate problems, but among them there was an issue with questions of fraud.
So there's allegations of fraud. I think what's important about both of those is that neither of those were in the direct lending or BDC market. And so I think what gets lost in the media...
Business development company.
Correct. So I think what gets lost in the media sometimes is that there's this issue in private credit. None of the instances of fraud that have been publicized in the press are actually in the direct lending market. They're in the bank market, they're in the broadly syndicated loan market, and then they're in the more kind of esoteric parts of the broader private credit market, but they're not in the direct lending market that, most people have exposure to.
Well, but don't you think that the banks started to dip their toe into private credit? I mean, it was just on March 12th that Morgan Stanley said that its private credit fund would not be giving back all of the money that investors were asking for, because the way these private credit funds work, you only have certain points on the calendar where you can get your money out. So caveat emptor, investors should understand the fine print, but there were a lot of people trying to head for the exits, and that's a Morgan Stanley fund.
Right. So this comes back to the data. So again, there have been a handful of these instances of fraud, most of them actually not in private credit, none of them in direct lending. When you look at the data in both public credit and private credit, in public credit, the actual default rate that we're seeing right now is about 1.3%. If you add in kind of liability management exercises, which is kind of a little bit of an indicator of distress, you get to 4-something%. If you look at private credit, if you look at the non-accrual rate for the top 20 BDCs, the average non-accrual rate is about 1.54%.
Okay, small.
So that's an average level. By the way, there's dispersion around that, right? So we're at 10 basis points. There's people that are higher, but it averages to 1.5%. To put those numbers in context, at the height of the global financial crisis, the default rate got to 10.82%. And so when you look at any of these numbers, for every article that you're seeing, there's, out of 100 companies, for every article that you're seeing about a problem, there's 98.5 other companies that aren't having a problem, and that's an average. Of course, there'll be dispersion around that, but that just kind of frames where we are right now.
Well, again, this is a Wall Street Journal article about John Zito over at Apollo, but when he says that Joe's software company, and that's where the real problems perhaps come. I mean, you look at Tricolor and the other issues, that's not necessarily, those are very, very specific issues. But the perception alone that these software companies, mid-size, many of them which have gotten loans from private credit companies, that the perception is they are going to be in trouble because what they do is going to be obsolete because of AI. That may or may not be true, but the herd believes it is. And that's the interesting thing about black swans. Who would have thought that the perception alone would get people trying to pull their money out of private credit?
Yeah, so on software, look, I think the market is reacting to AI disruption risk kind of across public and private markets. You can see it in equity markets, you can see it in debt markets. As you know, kind of shares of publicly traded software companies are down 30% or more. If you look at the corresponding impact in credit, double B loans on average are down about 2.5%. Single B loans on average in the public market are down about 9.5%. And that dispersion between the equity reaction and the debt reaction makes sense, because on the equity side, people are re-rating what they believed to be higher than market growth and kind of robust terminal values. And so if AI is disruptive and margins come down, then those values come down. In credit, what's important is, again, those numbers are averages. So some companies, loans are only off 0.5%, others are loan 15% or more. And so I think not all software is created equal, and I think you'll continue to see kind of a range of impact on software companies based on their business models.
Okay, so and yet it is affecting bigger names. BlackRock, January 29th, came out and said that it disclosed it had a 19% decline in the net asset value of the investments it owns. Okay, it's got a total asset of value of $1.8 billion in September. These are just things that happen. So may I ask about Goldman? Have you guys in private credit been hit with a flood of redemptions that is outsized compared to the average point on the calendar?
Right. So we just disclosed a few weeks ago that our redemptions did go up a little bit. We were at 3.5%, but our inflows have also gone up. So in December, our inflows were actually up 11% versus the rest of our 2025 average. Our most recent month, which is the February month, we actually had our second biggest month of inflows ever. I think that we've approached, we also have exposure to some of these broader markets, and so I'm not saying we're completely insulated from some of these things that you're seeing in kind of traditional retail. But I think for us, we've been very intentional about how we've kind of approached retail. If you look at our kind of US BDC complex, it's only about 17% of our private credit AUM. And within that, the majority of it actually comes from institutions or ultra high net worth through our own kind of private wealth channel. So our exposure to traditional retail is only in single digits. And so we're not nearly as exposed to this as some of these other figures that you're reading.
Well, you've been doing it 30 years. And one last thing really quickly. What would you tell investors to avoid if they're thinking about going into private credit? What kind of due diligence should they do?
Look, I would look at the track record of the manager. What's their origination funnel? What's their diversity of funding? What other sources of funding do they have? And I'd look at what their actual experience is. I'd look at the data and look for, is their PIK increasing? Is their non-accrual rate increasing? This data gets published every quarter, and it's easy to diligence.
Thank you so much for coming on, Vivek, to talk about this. Let's hope it floats away.